Welcome to the second video in chapter 4. In this video, we're going to talk about bank reconciliation and work on a couple exercises. So what we look at over here is the balance of cash in the company's record may or may not be equal to the balance of cash in the bank records at the end of each month. We prepare a bank reconciliation statement to reconcile the two balances. The two most common reasons why we have differences are timing difference and errors. Timing differences are something within a couple of days, hopefully, the numbers should work out to be the same in both what we have and what the bank says we have. Errors are something that may or may not get resolved unless we discover and resolve those issues. So let's take a look at what these issues could be and how we would resolve these problems. So let's start out with reconciling the timing differences. So to reconcile the bank's cash balance, the cash transactions recorded by the company but not yet by the bank. So the company has already done the transaction, they've recorded in their books. They have either increased or decreased cash accordingly, but the bank has not done it as yet. So why would that be? First one is deposits in transit. These are cash receipts of the company that have not been added to the bank's record of the company balance. What that means is I have deposited a check, let's say on December 31st. On December 31st, in my books, I already had cash debit and let's say sales credit. This cash or check that I deposited on December 31st has not yet been put into my account by the bank. They collected it from me. Or I may have put in a night deposit, but they don't have it in my account as yet. In a matter of a day or two, it is going to be in my account. So I will add it to the bank side. Checks outstanding, on the other hand, means these are checks that I have written out and made as payment to vendors. I may have written this and mailed them, may not have reached my vendors yet, or it's reached the vendor, they've not yet deposited, or they may even have deposited, but it's not yet cleared the bank. All that means is, in my books, I'm already saying cash has been paid. It's credit, cash is debited, cash is credited, saying that this money is out of my account, but the bank is still showing the money in my account. So deposits outstanding and checks outstanding are two timing differences. Now, it's possible that we may have errors, and these errors we'll take look at some examples and see how to reconcile them. Now, step 2, let's reconcile the company's cash balance. Okay, so now what we're looking at is cash transactions recorded by the bank, but not yet done by the company. So the bank has taken care of certain transactions for me or on my behalf, and they have already updated my account by way of increasing or decreasing it, and I have not done it as yet, and I need to do a journal entry to bring it up to speed. So common items that will increase my cash balance are bank collections on the company's behalf. A very common example is if you have a direct deposit of your paycheck, that money is going into the bank has collected that money for you, that's already there. You don't have to do anything about it. You just need to update your records. So for companies, a similar situation is, take for instance, if it's a landlord, their rent that's paid is already deposited in the company's bank account because the money is paid directly to the bank. Any interest that is earned, that money the bank has already credited your account, added to your account. You've not yet done it. You see it later on, whatever the amount is, and you add it to your account. Now, reasons why your balance is decreased. The bank has decreased your balances because you have electronic fund transfers. So you had given information to the bank telling them that you've given them standing instructions to pay your BG&E bill, your Verizon bill, your T-Mobile bill, whatever those bills are. Those bills are paid automatically on the said date for the said amount, assuming obviously you have money in the bank. So that has been done automatically. You may or may not have done your journal entry to reflect, and this is an opportunity for you to catch up, okay? NSF checks is non-sufficient fund checks, okay? This is a situation where you received a check from a customer You deposited the check into the account, into your bank account, and you did your journal entry, cash debit, accounts receivable credit. Or it may have been cash debit, sales credit because you received the money. Now what you found out from the bank is when the bank went to clear the check, that money was not there in your customer's account. So they have now effectively said that money is no longer in your account. They're taking it out of your account because they had given you that money, assuming that check was going to clear. Now, a standard assumption that all textbooks make is we may have the misfortune of receiving a bad check, that's an NSF check, but we never write a bad check. So whenever you see NSF check, the assumption is you received a bad check from a customer. Then if you have debit card transactions, again, you've used your debit card, the payment has already gone out of your account. The money has gone out of your account. You need to update your records. And bank service fees is also something that you will be notified of in a bank statement, but the bank has already taken care of it. And then again, if there are any errors, you need to reconcile it. So a bank reconciliation statement is an internal document. You do not share it with an outside party. However, it's a document that is always used by the auditors, is requested by the auditors, and it's always a good idea to be as formal as you can, as you would do with any other financial document. So you have name of the company, name of the statement. It is always at the end of the period, so end of the month. You have two sides. It doesn't matter which one you put on which side. You have the bank's cash balance and company's cash balance. You will have the description and then the amounts. The end result should be you come up with the same number on both sides. It's called the adjusted balance or the true balance. So on the bank side, you start with what the bank says you have, add deposits in transit, subtract your checks outstanding, and if you're given details, write down all the details in the inside column and put totals in the outside column. On this side, you have cash balance. As per your books, whatever has to be added. So if notes was received, which means collected, you earned interest on the notes, you earn interest on your bank account, all of those will be added. Subtracted are NSF checks, any debit card payments made, ETF transactions, electronic fund transfer transactions, if there were any service fees, all of those need to be reported over here. And here the error correction could be a plus or a minus. In this particular example, they're just showing over here, the error correction, you have a minus 300, which means you had subtracted 300 less. Now you're doing that adjustment over here. So once again, we examine items used to reconcile the company's cash balance, debit cash for items that add to the balance, credit cash for items that subtract from the balance. So why do we need this? You need to do a journal entry. You cannot change any account balance without a journal entry. So the journal entries you would do, you would have a debit cash and you would credit the accounts where you collect the cash from. Here it is, you debited accounts, they're all expenses, and you credited cash for the money that was paid out of your account. Now, again, this is a summary, and we will take a look at two exercises, and we will work with those two exercises in the next video.